All right, great. Yeah, thanks for having me, David. As he was mentioning, yeah, my main focus is day trading, E-mini futures. I do a little bit of swing trading, and the two of them make actually quite a nice pairing because you tend to have lower volatility environments corresponding with good, steady trends in a swing trade, and then higher volatility environments, you're going to have more day trading opportunities. And then typically it's a bit harder to stay into swing trades. So we can just look through a handful of various stocks. I always like to start by relating everything back to either the S&P or the NASDAQ. And the reason for that is because you're going to get a barometer of what's the broader market doing. And if I'm getting into a individual stock, then I want to know, is this stock relatively strong if I'm going to go long, or is it relatively weak? And if I want to get long that stock, if it's relatively weak compared to the S&P, then that's doesn't bode well for, you know, a rising tide lifts all boats. And if that stock you're looking to go long of is already strong, it's going to have a higher beta and lift even further. So if we start by looking at the S&P, the SPY is helpful just because you can kind of get some volume data in there. The last couple of days, we've pulled back to the 50% retracement. We've also pulled back to a 21 EMA. That's really about all I use for indicators. The main thing I'm looking for on the chart are the relative swing highs and swing lows. So looking at where are we in relation to the prior high or low. And so at the moment, I'll just get rid of this here, where we're at in the trend, we can go back to the weekly chart just to get a really big picture and say, okay, the last couple of months, what have we been doing? Well, we've pretty much been going up on a tear. And the last month and a half, it's been into all-time highs. But pretty much since the start of the summer, late spring, start of summer, it's just been up, up, up. So when we drill down to the daily chart, if we're thinking about, okay, want to put on some individual stock trades to hang on to as a swing, might be a couple of days or a week, but more than likely the goal is to be in it for a couple of weeks, sometimes even a couple of months, if we're trying to catch not just a quick overnight move, but more a longer term trend. Sometimes the overnight moves can be really good to trade options with, because you get kind of that that leverage effect. Similar to trading futures, you're going to have a lot more leverage, which can be good or bad. But if you can stay in control of the risk side of the equation, then having the extra risk, or having the extra leverage rather, can really do a lot for kind of accelerating the growth early on. And so if we kind of get back to kind of the fundamentals of the broader market, looking at the S&P and determining that, okay, we're in a strong uptrend. If we go to the daily chart, we are just been, higher highs, higher low, higher high, higher low, higher high, higher low, nonstop, new highs. And so that uptrend is very, very strong. Then the next thing I like to do is compare the S&P, the Dow, and the NASDAQ to each other to get an idea of how strong are, these specific indices. How strong is tech relative to the Dow, relative to the S&P 500? So if we look at the NASDAQ, we are pretty similar to the S&P as far as relative low to low. And if we look at the Dow, the Dow is actually a bit stronger. So I would say the Dow is currently the strongest from this pullback because it's had the weakest of the pullbacks. And then we have what I would say the S&P is the next strongest one, and then followed by tech with just a little bit deeper pullback. The top of this hammer candle from yesterday is kind of right at the 21, and then if we look at the SPY, the body or the high of the hammer is kind of above the 21. So that kind of gives us a baseline for what's going on in the broader market. What is that trend? So then if we were to start to plug in, some individual stocks, just going through some of the bigger names, if you look at a Google and you see here, okay, well, yesterday we put in a hammer on Google, and what was the S&P doing? Well, S&P also put in a hammer, and no surprise there because the Mag 7, some of these bigger names are going to be a big portion that make up the S&P 500 and the NASDAQ. So it's going to make sense that some of these bigger names mimic the S&P pretty dang well. We can also take a look at a 50% retracement and get an idea of, okay, yep, this one pulled back. Basically, it's identical to the S&P. If we were to look at just some other random names, and first glance, we can just make a quick observation of the, in this case, 6-month trend. What I like to do is pull a list of stocks making 52-week highs and 52-week lows at the end of each day. And so I just have a saved FinViz scanner. You can also do it in Thinkorswim or whatever platform you're on, Ninja. And I will add those stocks each day to a watch list. I just copy them over to Excel, remove the duplicates, and then I'll go back to those stocks a few days later. And that way, I already know if I, had pulled the 52-week high list last week, that Google is close to all-time highs. Bad example, I suppose. That one didn't quite make it up there. Let's see what we got. Let's see. Now we'll go to Axon because that one's been that's one I've been trading here. So Axon, as of 2 weeks ago, would have populated on my 52-week high list. And then I can go back to that a few days later, a week later, and see if it's pulled back. And then I can look for an entry into a resumption of that uptrend. Because it's on that list of 52-week highs, I already know that, okay, the trend for that individual stock for the year is going to be up. And so it's already kind of a strong stock being on that list. And then I can relate it to the S&P. And I can say, well, the S&P's been in a strong uptrend this year. What's Axon been doing? Well, they've been also in a very strong uptrend with some pretty big surges around earnings. We've got this sell-off here at the beginning of the year, but a lot of these earnings have kind of catapulted the stock higher. And so knowing that, we can then come back to the stock when it's not so flashy and so on everybody's radar and look to get in on a pullback. So this particular one, I haven't had a ton of swing trades this year. Just, I guess, kind of by nature of doing a little bit more day trading and trading a little bit less this year than I typically would. But Axon was one of them. And it populated on my 52-week high list, kind of at the start of the year. I'm actually surprised this Axon, I don't see any media coverage on this stock hardly ever. I'm in Scottsdale and they're also in Scottsdale. I also have a couple friends who work there. So maybe just by nature of proximity, it's been on my radar a little bit more, but they have gone absolutely gangbusters. The lows down here is almost 450 and the high is, double that, 885. So if you go back just a couple of years, it's it's, kind of been on a Netflix Nvidia trajectory. But anyways, they don't all have to be, going 3, 4, 5x. The idea is it pops on your radar because it's been making a 52-week high or it's a strong stock. And after you get a pullback, then you can look to get into the trade or get into the stock. And the way I like to do it for swing trading is just wait for a swing high to break. So kind of was looking at it last year, started this year, we had this bigger sell-off. It seemed a little bit questionable just because they've been growing like crazy. And then they kind of went sideways for a while. We had the tariff news in there and, a bunch of other stuff come out that, could positively or negatively affect them. And they just kind of held steady and went sideways. Then we kind of got this double bottom here in April. And when we started to rally out of this double bottom, notice how we broke this high over here. And this is kind of you can use this high or we can go all the way back here. Either one is fine. But this was kind of the high that we made in the middle of this double bottom here. And so when we broke that over here, I just waited for that next pullback to enter. So in just entering, I just used the high price of the lowest bar in the pullback. So we're pulling back a couple of days, pull back all the way to the 21. And then once we break the high of the low bar, I just use that as my entry. If you're into fibs, you could, draw up a 50% retracement, kind of pull back to the 50%. That's a good sign. We start to bounce and then we break the high of that daily bar. And so getting in the very next day on the 22nd of April is kind of where I would place my order to get in and just, let it fill me whenever it happens to fill me that day. So I just put the orders in the morning and just let it go. I usually do like 10, 15 cents over the high and, buy stop. And then calculating the number of shares based on where your stop is going to be. So I like to put my stop below the entry bar. So in this case, this candle, they look, like normal sized candles, but then when you look at the actual range, this is a $25 candle, 25-point candle. So if you wanted to risk $100, let's say on the trade, you would divide that $25 because I'm getting in, a few cents above the high of the candle with a stop, 10, 15 cents below the low of the candle. So that basically puts us at 25. We call it $26. And so you're looking at about 4 shares would equate to $100 stop loss. If you wanted your stop to be way down here below the prior swing low, okay, now you're down at 465 with an entry at, we'll say 565 for simplicity's sake. Now you could really only buy 1 share if you wanted to get in with $100 risk. So those are some things to consider when you're trading stocks. I know most of you are probably pretty well versed with the way you like to enter trades, but not everybody pays much attention to the risk. It's easy to, get excited about a stock and think about, oh, if it, 3, 4, 5X's, I'll make this much money. But it's more important to focus on the risk side of the equation so that you can be there over the long run to be able to trade year after year. I guess I didn't give much of an intro about myself. I've been trading for 15 plus years. I'm from the Chicagoland area, and so lots of access to traders and, obviously the Chicago Board of Trade, Mercantile Exchange. In the kind of early mid 2000s was the coming of age with Thinkorswim. So Tom Sosnoff, Don Kaufman, got to know those guys pretty well. I went down to the trading pits for a little while, and those traders down there, a buddy of mine, a buddy and I suppose, shooed us away and said, you know what, the pits are dying. You want to be trading on the screen. And so that's kind of how we turned to the trading screen. swing traded a little bit and then quickly was introduced to futures. And then they showed us, kind of the ins and outs of day trading. But I still like to swing trade, and there's a lot you can do with individual stocks as well as options. But that idea of what's the broader market doing, and then what is the individual stock I'm looking to get into, how is it reacting relative to the broader market? And if you want to get long, wait for a swing high to break, wait for a pullback, and then get in above the high of that low bar. And then from there, it's really just a matter of monitoring the swing highs and swing lows each day, each week. I'm not really concerned with the intraday price action that goes on with the stock. I'm only looking at the daily bars with swing trades. And then I'll just trail my stop if I'm long below the swing lows. So we start to move up, and then we get this pullback. I just leave my stop alone underneath that initial entry point. And then once we pull back and break out and break the swing high, then I'll just move my stop underneath that next swing low and just kind of repeat the process. Occasionally, if we get a strong initial move, I will take 20% off, just a small chunk. I'll try and trade it in a way to where, if it gets a big move in the first couple days, if I can exit my risk on the trade, so going back to that $100 example, or we could say $1,000 example, if I'm risking $1,000 initially to get into the trade, and I can pull out, $600, $700, maybe $1,000, if it's a strong initial reaction, if I can pull that out, or even take half of that, take a $500 profit with just a small number of shares, I will do that to kind of reduce my risk on the trade. And then you can just let the thing go, let it rally. And then when it pulls back, I'm letting it. So here we get this little 1, 2, 3 candle pullback. Let it break the swing high over here. And then I can move my stop up underneath the next swing low, next swing low, next swing low, just continuing to do that. This is where I got taken out here when we broke. So this is the swing low. We bounced, but notice we did not break the swing high. And then we came on in this big red day here in the beginning of July, it was, that stopped me out. So then you're, collecting the difference between the entry and the stop on the final trail stop. So that's a really good way to manage positions. There's not a lot of anything you really have to do other than I will check on it at the end of the day, or usually after hours, and see if I need to adjust my stop for the next day, and then I'll do that. But for the most part, if it's climbing, there's nothing to do. Let it pull back, and then you need to let it break out before moving your stop. So that's a good trail stop technique. There's a couple tickers in the symbol in the chat here, DGX. So something like this, same thing, okay, making a 52-week high. I wouldn't just buy it today. I would let it pull back. And so if we zoom in a little bit, I would say pulling back towards this 21 exponential moving average, or just looking at where are the prior highs at. And if we can get a pullback, if all we did was pull back to this high here at 181, 182, you really just have a bull flag. And bull flags are great because they're indicating strength. You really only want to see 2 or 3 days of consolidation before it breaks to the upside if you're long. If we're getting, 4, 5, 6 days and it just starts to dip and look more like a flag. So if it starts to give back more than 50% of the pole, if this is the pole, now you're starting to get in trouble. So like from the breakout day, that becomes the pole. If we consolidate right here, now we're kind of up in the top third, top half. That's all well and good. The exception, or one thing that I would look for and see as strength, is if we come down and get some kind of hammer here with a tail that, sticks way down below, that would be indicating, I can't really draw it very well here. Let's say that's my hammer. That would be indicating that price did sell off and then was rejected and bought up. And then if we closed back up near this prior swing high, now that's a good opportunity to look for an entry, above that candle's high. You could, like I said, if you're into fib retracements, you could drop a 50% and try and get in there with your stop below the 61.8. That's a good entry tactic. But really, a lot of traders spend so much time focusing on the entries. And in day trading, yeah, entries are important. They're still less important than you would think. In swing trading, it's less critical. With options, yeah, there's your timing is probably the most critical with options. If you're going to be buying calls, you need to be getting in when the market is down. So getting in on the breakout can be a little bit tricky. And then you want to be closing out those calls. If we're just talking straight directional trades, you want to be closing them out when the market is moving in your direction. There's some things you can do with, verticals and you can get very complex with options, but the more complexity that you introduce into the option trade, you're going to start capping and limiting your risk. So when I've traded options, I've typically just done directional and kept it simple so that I have unlimited upside with still limited downside. The trouble with options is not all stocks are going to have them, and you find a great stock, and then you want to, get in, and then there's not a great option chain to work with. And then you also have the expiration challenge. If I'm buying options on a swing trade, I'm typically just going to play it for a week or two. So I only need to buy a couple of weeks out. But anymore these days, the last 5-10 years, I mostly just bought the underlying, and then I don't have any kind of time cap. And as you grow your account, it can become more advantageous to buy the underlying stock just because you have more capital and you don't have that time crunch with the option expiration. The one thing I will say about swing trading, and it can be easy to fall into the trap of looking at your percentage returns on that individual trade. So let's say I bought this thing down here above this little hammer, and then I closed it out today at the new all-time high, or the high for the last year at least. If I made 50% on this trade, on this individual position, that sounds really great, and it is. But if I'm risking 1% of my total account value, how much return relative to my capital, my total capital that I'm applying towards trading, what does that return look like? And, not that you want to be risking 50, 60% of your account per trade, but there is a point at which you need your risk per trade to be large enough to where it is meaningful. Same thing with, I guess Bitcoin's a bad example just because it's gone up so much, but you buy a couple of Bitcoin and, if it 2, 3, 4, 5x's, you want the risk to be asymmetrical to the reward. So if this pans out, does that have an impact on my life? So with your trading, risking 1 to 2% per trade is fine. But if you only have $10,000 that you're working with, swing trading stocks is probably not going to be the way that you're going to make a bunch of money, or at least be able to scale your account to $500 to $1 million just by trading. So you do want to keep that in the back of your mind, kind of the bigger picture, and having I'd say at least $100,000 to have a couple of bigger positions on, because with stocks, you also run into not necessarily being able to trade all the positions you want, because even if you have 50% margin, you're going to be tying up some of that capital with the active stock positions, especially if the entry candle is very small and you're able to buy a lot of shares. Then you can really end up having this big position on the same risk. If you're risking $1,000, if that candle is only $2, you're going to be able to buy a lot more shares than if it's $20. And so then you're going to end up with a bigger capital allocation for that trade. So, but yeah, sometimes I, talk to traders and it's like, they're doing really well. They're making 20, 30, 40% return on these individual trades, but you got to get to a point where that return becomes meaningful. And, yes, there's scalability, but if you don't have, some roadmap for going from, risking $100 to $1,000, basically growing your account size from 100,000 to 500,000, what is your next best alternative is just owning, an S&P mutual fund. So your returns that you need to make to swing trade, not to turn everybody off from trading. Obviously, I love trading. It's my, bread and butter, my, I wouldn't say it's my life, but it's a big part of my life. But you just want to be conscious that you don't, spend all this time having great trades, making 50% per trade. But if you're only risking $100 total per trade and you're only making $50 profit per trade, at the end of the year, was it worth all your time to do that? Like, what was your total return relative to your total allocated capital amount? So just some things to think about. We can run through just a couple of these here real quick before we run out of time. JBL, first thing that stands out, yeah, good uptrend, but we kind of have this double top or triple top rather here. And so, yes, there was a hammer as we had yesterday. I would watch for a rally to the underside, which is now a short, the underside of this consolidation here. And I would actually prefer to short underneath this consolidation at 216 than try and get long. Now, you could take a long and try and ride it to 216. That would be, perhaps an option play that, because it's short, it'd be short term. You're expecting a couple days rally and then sell or short at 216. And then the other one here was PYPL. This one's a bit messy, downtrend on the start of the year, climbing out a little bit, and then the last couple of weeks, kind of a descending triangle where we have lower highs kind of being put in, but then also a horizontal triple bottom. So something like this, I would look to kind of sell, maybe look for an inverted hammer or like a bounce, and then either sell the top of the range ahead of a breakdown. And then when you have a triangle like that, you're kind of using the widest part of the triangle as your projection down. So this one is 73 down to 67. So we just call it, 6, 7 points would project down to like a 60. And that would kind of take us back down to these prior lows here. So not one that I'd be super excited about trading, just because there's a lot of congestion back here. So that's our closing bell, and that means my time's up. So thanks, Dave. I appreciate you